Hello, everyone, and welcome to the Me Financial Podcast. I am Michelle Moses, your host. I am a certified financial planner, realtor, and former e-commerce store owner. And today we are going to be talking about how to get the most home for your money in today's interest rate environment. And to talk about this, I have Jeff Ohm with me, and he is the managing partner and producing branch manager of Forward Loans. Congratulations, because this is a new role for you, correct?
It is. Thank you.
Yeah. And he has an MBA from Arizona State University and more than 18 years of lending experience in the consumer finance industry. He has access to a full range of mortgage sources and can shop any loan. So that basically that's what it means to be a broker, correct? A mortgage broker. And he also helps to run the historic home tour here in Phoenix, Arizona, which is how I originally met him. So thank you. And thanks for being on the show.
Thank you for having me.
Yeah. So today we're going to talk about how you can get, so interest rates are all the, we all had a super hot, home, what am I trying to say, market. And, everybody's home, they're so happy with that their value is going up, but it has made it very hard to move, right? Because now rates have gone up and things are cooling off. We all know this story. And in my opinion, things needed to cool off. Otherwise, no one was going to ever be able to move. Like your house always needs to be able to be affordable to what the wages are nationally. I mean, do you kind of agree with that?
Yeah, we obviously during the pandemic, 2020, 2021, it was quite the frenzy.
Yeah.
But because of that, we have a lot of people that are locked into their homes with those lower interest rates.
Right. And it's not a bad thing. It's just that, things go up and down, and that's what it is with the stock markets, what it is with the housing market. And for me, I just personally think that the ups and downs create buying opportunities, and that's how you make money. It's the same in the stock market. I think you just need to understand it. I just think that the home market, obviously we all need homes or a place to live. And it's just a lot more closer to home. So let's start out. So we are going to talk, because I originally asked you on here because Jeff did a video about assuming a loan. So tell me a little bit about that, because I had not heard a ton about it except for a VA loan. Yeah,
that has been a very hot topic for this year, 2023. So as you know, as everyone knows, we did hit 8% in interest rates. They have come down, thankfully. But we're still in the sevens. And what that is there are some loans, FHA, USDA, VA.
And the USDA one is only, I don't think people have heard of that. Which one is that?
So USDA, typically it's a rural loan. Okay. There's only a few areas in Arizona that even qualify anymore.
Right.
And typically they're outside of the city. They have a small census. Mostly in the Midwest and other areas, but like Florence, for example, would qualify for USDA. So,
and then VA is for veterans, and then FHA is what people are more
correct.
So those are kind of sponsored by the government, and you can put 3% down, and then you have the mortgage insurance. It's guaranteed by the government, basically.
Correct.
Yeah.
Yep, it's guaranteed by the Ginnie Mae, which is FHA, and then obviously VA. Has it's called a funding fee, but that's an insurance as well.
Okay.
So, and the way that works, actually have a situation today. So they have a veteran, the loan is at 2.75. The loan balance is $500,000. They're selling it for $725,000, and they're soliciting or selling the fact that they have an assumable loan at 2.75.
Now, do you have to be a veteran in order to get this assumable? And assumable, you guys, means basically that you're going to take over the loan at that rate. So the name on the loan would transfer to the new owner.
Correct, and there's a process, and we'll get into that.
Okay.
So as a veteran, you do not have to be a veteran to assume a VA loan.
Just to get it in the first place.
Correct.
Okay.
But what happens is every veteran is given an entitlement, and that entitlement is what allows them to purchase a house. If that veteran sells to a non-veteran and let's say the process is done, that entitlement still stays with that house.
Because the loan, it's kind of staying with the loan.
It is.
Right? Okay.
The entitlement is staying with the loan. and that is not a benefit to the vacating veteran.
Okay.
So if that veteran, he or she, are good with walking away from that entitlement and don't plan on purchasing another home of that same value, then they're in a good position.
What if it was a husband and wife and they were both veterans? Do they each have an entitlement, but they'd be how does that work? Because if they're co-borrowers.
Yeah. So, okay. So that's kind of going to.
That's down another road.
No. Typically, most often, the husband and wife are not both veterans.
Okay. It's just the one.
Correct. Now, if you had a husband and wife that were veterans, you could use both entitlements. And that's a really good question, because I would assume maybe one entitlement is attached to the house.
And then they could take another one and go buy another one. But if that never happens, then we don't really need to talk about it.
It's very rare that that happens. But going back to that situation, the new buyers would have to come up with the difference between the loan balance and the sales price. So that's $225,000 cash that they would have to put down in order to qualify to assume that loan.
Because no mortgage company wants to be the second on it of 225, basically.
The issue with the VA is you can get a second, but the VA requires that it is an assumable second.
Okay.
And there's no one out there that are offering assumable seconds. Now, the seller can choose to do a seller carry, but then the seller will not realize that cash benefit until that's refinanced or paid.
Okay.
Does that make sense?
Yeah.
Seller carry.
But explain what that is to people that don't know.
So what a seller carry is that $225,000, the seller would basically create a trust, create a lien, create some sort of payment towards that, and then do a type of balloon payment, say maybe 5 years, 10 years.
So they basically become the mortgager.
They would become a lien holder on that side.
Right. So then you would have two liens on the property.
Yep.
Okay.
But going back to the process, so all FHA, everyone has an initial servicer, and it may be Mr. Cooper, it may be Cross Country, Freedom Mortgage, Rocket. There's tons of servicers out there, and they all have different processes as far as that qualification goes and that transfer goes. As a listing agent or a seller, the first thing that I would do before even putting in the comments that this is an assumable loan is I would call that servicer and see what their requirements are.
Okay.
I would see what their requirements are, and then I would ask them how long that process will take, because there are some servicers that are taking up to 180 days.
Oh my gosh. So you could have a contract on a house and then have to wait to close.
Yes, and the issue with that is, as we've seen, we had contracts go under in the summer, April, May. The market was hotter then, and 120 days into the transaction, say in October, it still wasn't completed.
And the house had gone down in value.
House had gone down in value. Buyers got frustrated. Buyers canceled. Sellers went back to the backup offer, but they had already found another house. And now they're sitting in a position where they've been off the market for 90 to 120 days. They've lost value. They've had to relist. So there are some risks on both sides.
Yeah, of waiting the 180 days. Okay.
Correct.
Yeah. Okay. So that is one way of getting a loan, is assuming it, but you've got to be able, it sounds like, is this something that's really viable? Because it sounds like there's just a lot of.
It is viable as long as you have the right servicer, you have a motivated seller, and you have a motivated buyer with the means to complete the transaction.
They have the cash to pay.
Either cash, or if they can get a HELOC or a second. But you really have to look at what that blended rate is, because those seconds are in the 9 to 10, 11% range.
Yeah. So if you got 2.5 on the first, and then you're 9% on the second.
Yeah. You have to look at that blended rate.
Yeah. You might be at 5 anyway.
But I'm in numerous Facebook forums, and they are completing them. And there are some servicers that have the capacity and they're getting done in 30 to 45 days.
Okay. All right. I mean, and I always think that this is the way of the world. I mean, you see it with laws, and it's the same in the financial world. It's kind of like when there's a situation, people are going to find a way around
Correct.
it. Like they're going to find a way to get in that house,
Right.
And so I think if this is an option for these low rates, then people are going to do it. Cause I could see how the VA, if someone had cash, they'd say, okay, well, I'll just downsize for a little bit or, and take this cash.
Yeah.
Yeah. And leave my loan and my entitlement with this loan.
Yeah. And in the situation, that first scenario that I was telling you about, they've been on the market for quite a long time. So this could be that final attraction to get them to go under contract.
Right.
So,
Okay. Yeah, because if they couldn't afford the house payment, they're going to do anything they can to get out from under it, basically, and get some cash. Okay.
Yeah. And with that being said, I just read where the VA put a halt on foreclosures. There's quite a bit of VA homes that have gone delinquent, and this could be a good opportunity for those servicers to avoid foreclosures,
and
get
then
them
to
on
sell
the market,
house. Yeah.
have people assume those loans.
Mm-hmm.
This could be a good opportunity for that as well.
Okay. And then before we started, Jeff was talking about how we could do a whole podcast just on VA loans because they are that complicated. So we'll probably have him back to talk about that too, if you guys are interested in that. Okay. So the next thing that we were talking about, and I think this kind of goes in together, was so what's popular right now is a lot of seller concessions. So people are trying to keep the value of their house high and sell it at that higher rate or higher amount. And then when you need something fixed or anything, or they're offering to buy down the rate. And when you'll see this in the news or you hear this lingo around, it's called a 2-1 buy down. So can you explain a little bit of that too?
Yeah. So when we first consult with somebody that's interested in purchasing or getting pre-qualified, we always ask them what's the most important thing. Obviously, rate is important to everyone, but it is what it is, right? But there are ways to mitigate that and lessen the payment. And the way that we do that, let's just take another $500,000 house, for example. If you were to lower that purchase price by $25,000, that would maybe save the borrower a couple $100.
Right. It's not, you got to lower it by a lot. And that's why that's why the rate buy downs are so much better, is because you're spreading that out over the 30 years versus, $25,000 you're saving is just not going to add up monthly.
Right. So I'll give you an exact example of a purchase that I just closed. So it was a $735,000 purchase, $200,000 down because they had just sold their previous home. So they had the cash to put down. And they received 3% in seller concessions. So it equated to about $27,000. We were able to buy the rate down to 6.99. So that was a permanent rate down, less than a point at the time. This was in October. And we did a 2-1 temporary buy down. So their initial rate for the first 12 months was at 4.99. That scenario alone saved them over $800 in monthly payment.
Wow.
So, and that we also had a little bit left over to pay for closing costs. So typically a 2-1 temporary buy down, a good rule of thumb is it's going to be about 2% of the loan amount. So in this case, it was close to $12,000.
So can you explain what a 2-1 buy down does for people though?
Yep. A 2-1, what it's doing is it's a prepaid interest account. And basically the seller, you're using those seller concessions to prepay that interest for 24 months. So for the first 12 months, you're taking 2%. So, between 4.99 and 6.99. So that 2% is in an escrow account. So every time they make a monthly payment, the borrower is paying what would be 4.99, and then they're pulling that additional 2%
in the escrow account.
To go to the servicer. Now, what's nice about that is those funds are never lost. So if that account is refinanced within that 24 months, whatever's left over will be applied back towards the principal.
Oh, so if rates went down and they wanted to refinance, then they could. Oh, okay.
And that's a nice benefit versus a permanent buy down. It is what it is.
Yeah, you're buying down the rate for the life of the loan.
And it's a sunk cost. So if you come and you refinance that in 18 to 24 months and you haven't hit your break even, those funds will never be recovered.
Okay. All right. And these are really popular right now, right?
They're very popular. Homes are sitting longer. Buyers, there's a lot of buyers sitting on the sidelines because of rates. But right now you can get some really good deals, and you can get the seller to help mitigate those rates and lower your payments.
Okay. And so essentially the 2-1 buy down buys it down for 2% for 1 year. And then it would go on the second year, go to 5.99.
1% for the next 12 months.
And then, so why is it called 2-1?
Because
I get the 2, but what's the 1?
The 1 is the one interest rate.
1% every year kind of thing.
So 2% for the first year. 1% for the next year.
Okay.
And then it's back to the original
Back
699.
to the original. Okay.
Now, if they don't have enough seller concessions, they can do a 1-1, which is 5.99 for 24 months.
Okay.
And they can also do a 1-0, which is just 5.99 for 12 months. It still lowers their payments, just not as much and not as long.
Okay. So the numbers basically mean the first year and the second year.
There's actually a 3-2-1.
Okay, so that would be 3 years.
Yes.
Okay, so the first year would be 3%.
3.99,
okay.
4.99, 5.99.
So you can negotiate all of this when you're negotiating your contract for your house.
It really depends, though, on what you're eligible for seller concessions. So if you're 5% down or less, you can only get 3% in concessions. If you're putting down 10%, you can get up to 6% of the sales price. Now, 6%, it's not often that we get to 6%, but there's a lot that you can do on a $500,000 loan with $30,000. And if you're putting 25% or more, you can get up to 9% seller concessions.
Okay. And that includes, so first you're negotiating, right, for the sales of the house. And that is just something that's included because they want to sell it for higher. Then they give you the concessions of the 2-1 buy down, let's say. Yeah. But then you go through the inspection period. There are some things wrong and they don't want to fix them. They just say, here's some money, here's some money. That also adds to the seller concessions. And so if you're only putting down 5% and you already have a 2-1, then you need to really make sure of how many seller concessions that you're taking, correct?
There is a point to where you can't use anymore. Yes.
Right.
Correct.
And so so let's pretend that you negotiated the 2-1 buy down. So 2 years of some interest payment on your mortgage when you were negotiating the house. Then there's some things wrong and you had another 2%. And when we say 2%, this is the 2% of whatever.
It's always of sales price.
Yeah, of what the sales price is.
Correct.
So then let's say you had 4%. Then you could use that extra 1% because you're only putting 5% down on the house. You could use that to prepay like HOA. What can you use that for?
In the 5% scenario, you would not be able to go over
at all.
3%.
You wouldn't even be able to pay like HOA or prepay your insurance.
Yep, you're capped at 3%
for anything. Okay.
So that's it.
Okay.
So that's why you have to make sure that, as an agent, as a client, that you're working with a lender that understands these things. Because I have heard horror stories where they've gone through the Binzer, they've negotiated.
What's a Binzer?
The buyer inspection.
Okay.
What
I do, but I just want you to explain it.
It's when they're submitting their repair order.
Yes. Right? Yes.
And you're at that negotiating, and they don't want to do the repairs, and like, well, we'll just give you an additional $15,000. Mm-hmm. Well, it doesn't work like that, because if you're already capped at 3% and you're using all of it, Fannie Mae, Freddie Mac, we're not talking FHA or VA right now. We're talking conventional conforming loans. They will not allow any more concessions. They won't allow a lender credit. They won't allow an agent credit.
Wow. Okay.
You are capped at the 3%. Now, if you're putting 10% down, then
You can go up to 7%
you can go
concessions.
up to 6.
Oh, 6% concessions.
But
okay.
you have to make sure that what we do is we reverse engineer it and make sure that we can use all of those concessions, because there are times, they want to replace a roof, or they want to replace a sewer. Or
Yeah, there's some big priced items.
There are. And that is, those are the things that we may say, hey, have that come out of seller proceeds at closing, pay a contractor at closing, right? Those are the things that typically the underwriter is not going to require to see.
Okay, so if a contractor fixes it before the house is sold, then they would put a lien on the house basically, and then you would put it in the closing, off. And then they get paid when the house closes.
Correct.
Okay, so there's other creative ways to do it rather than just doing seller concessions.
Yeah, there are. And you really want to make sure that buyer is not in a situation where now they've bought this house, they're cash poor, and they don't have the funds to fix whatever major repairs are needed.
Right.
So we're going to look at all of that. We're going to say, what makes most sense? Buy it down, do the temporary buy down. If there's major issues like a roof or a sewer or even an AC may work. It may pass the inspection, but they're like, this thing's done in 1 year or 2 years.
Yeah. I mean, that's like $10,000, $12,000, $15,000.
Easily.
Yeah.
Easily. So,
and you don't want to be without AC in Arizona.
No. And that's actually
a law.
It's a safety issue.
Yeah.
It will not close if it's not functioning.
Right.
Yeah. So, and there's certain lenders that will allow repair escrows, but I try to avoid those at all costs. There are things that we can do outside of an actual repair escrow, either getting it done during the transaction or coordinating with the contractor and having the seller pay up front.
Okay. All right. So there are ways around it if the seller's willing to do it, I guess.
Correct.
So years ago, an ARM used to be really popular. And so where did the ARM go and the 2-1 buy down came in? Do you know what I mean? Like, how did we come? Because to me, it kind of seems like the same thing. We just have like these different names for it now.
Well, they're different loan products. And ironically, you cannot do a 2-1 temporary buy down on an ARM, believe it or not.
Well, I know you couldn't do that, but the ARM would still be just lower in the first couple 5 years or 3 years. But I guess it doesn't go up every year, so that's why the name of it is different. Mm-hmm. But it's kind of the same thing. With an ARM, it's like, okay, a 5-year ARM. Okay, it's low for 5 years, and then it's going to go up to whatever rate, right?
Yeah, so the issue with ARMs right now is things are funky because the Fed has continued to raise rates. Thankfully, it seems like that has subsided and they've said no more. So we cross our fingers. But we're in what's called an inverted yield curve, where ARMs right now, because of margins, they just don't offer, they're not as attractive as they used to be. So, financing jumbo loans, the luxury market, ARMs were always very popular, 7-year ARM, 10-year ARM, because the rates were lower. And most, luxury homeowners are not in those homes for 7 years to begin with. And if they are, they wait until they can refinance out of that into a 30-year fixed. But right now, ARM rates are similar to 30-year fixed rates. So now there are some retail banks out there. There are some credit unions that are holding that paper in-house, and it's kind of given them a competitive advantage, but they're few and far in between right now.
Okay. I've also seen, just as an advisor, I get people that call me all the time with investment products and things. Hard money lending is off the charts right now. I mean, because there's so much cash. People are just, people that have money have a lot of cash sitting in savings accounts waiting for an opportunity. Because they haven't felt like the stock market has been, all of this. And then housing, I mean, it's really expensive. Like if you're going to flip a house or something, I mean, you're paying $800,000 for this house. That's a lot of your cash to be tied up in one house. So I feel like there's a lot of cash and people are looking to do with it, what to do with it. So I've gotten a lot of calls about these hard money lending. So do you have any thoughts about that, about what's going on? Have you seen any of that?
Yeah, actually, I know quite a few wholesalers, and the hard money lenders are it's their kind of life source, believe it or not. So there's some really good hard money lenders out there that really like to work with seasoned wholesalers as well as flippers that will they can get up to 100% financing. So
Right.
they can put a down payment, get that house under contract, and the hard money lender, as long as you have a relationship, will offer financing for the renovation.
Right.
So most hard money lenders only work with investors.
And people that
It's
they know and that
Yep.
have it. Yeah. And the payment is interest only. Yeah. So they
Yeah.
start, and it's normally like a 6-month loan. But I guess I'm bringing this up too, because I kind of wonder if, like, okay, so rates are high and they are coming down. And I think they will start to come down. Like the mortgage, the way that I view it is, so the Fed kept raising rates, and it's kind of like the stock market. You're kind of building in expectations. And so the mortgage rates were building in expectations, and that's why they went up to 8, but really they should have been more like a 6.5. And so
Correct.
since they have started, the Fed is not, it looks like they're not going to continue to raise rates, then it should come down to, under 7 and 6.5 or 6. But if you can get a hard money loan, or if people are like, I'm tired of waiting, I will go ahead and give you a loan on this house. I mean, do you think that could be even a possibility? I just don't think that would be that big.
Yeah, so hard money for a primary buyer, I don't think is a viable option.
Okay.
A lot of hard money lenders will not, because of the way that they have to report and because of compliance reasons, they won't do financing for primary lenders.
Oh, I didn't realize
That's
that. Okay.
why they primarily
the short
do
term.
to the investors.
Okay.
Right. Now, we
How,
do.
can I ask, how is their reporting differently and all that? Do you know?
Yeah, it has. And again, this goes back to taking my UST days, taking my test. But
I love it when people ask me questions that
I know.
that I never talk about.
it really has to do with if you close a certain amount of primary loans, it changes your status.
Okay.
So, and that's really what it comes down to.
Okay. And you become more like a bank.
You do.
And you have to have like reserves and things like that.
all of
Okay.
those things.
Okay.
So,
and I like that. I think that's good, because otherwise it could blow up the economy.
yeah.
Yeah.
And so, we're not where we were back in 07, 08, doing negative amortized loans, interest only. There's very few of those options. Everything that we do is qualified. So, but we do have non-QM options. So we have bank statement loans. We have
What's QM?
qualified mortgages.
Okay.
So regardless of what we're going to, what vehicle we use, we're going to prove income one way or another, unless it is a DSCR loan. And these loans are excellent for investors that don't want to show their tax returns. They don't want to prove their income. They may own multiple properties. It's called a debt service coverage ratio loan. Mm-hmm. And really, it's just based on down payment. It's based off of a rental analysis, which is called a 1007 in your appraisal. And that's a market rent analysis. And as long as your payment is equal to the market rent analysis, and obviously, FICO score and those things, but debt ratio doesn't come into play. Income doesn't come into play. As long as your payment is equal to the market rents, you qualify for the loan.
And is that for primary or for an investment property?
Investment properties.
Only for investment properties. Yep. Okay. And so that's if you were renting like a single family home, not like apartments or.
Yeah. Now there are commercial loans as well, but you can do this up to a fourplex.
Okay. Which I think would be really, we have a lot of real estate investors listening. So.
And with that being said, as of November 18th, if buying a primary, you can get into a fourplex with as low as 5% down now.
Oh, wow.
And that's at the higher, because the new conforming limit just came out, $766,550. It's in Arizona, it's over $1 million conforming limit that you can get into a fourplex with 5% down.
Wow, that's amazing.
Yeah, so you can use the other 3 units to offset your incoming new mortgage to qualify.
That's wonderful.
It's
okay.
fantastic.
Yeah,
actually.
that is fantastic. Oh, well, thank you for bringing that up. Okay, yeah, and what we were talking about, so that 766 number of conforming, that's where you kind of hit the jumbo. So once you hit and you need your loan to be over that 766 550, then it would become a jumbo loan, and then those rates are, and all of that world is different, and the rates become different.
It's a lot harder to qualify in jumbo. They require tax returns unless you're doing like an AUS, which is a Fannie jumbo. But you're still going to have to put, 20% down. If you're not putting 20% down, the rates they're just a lot higher. It's not conducive. So, but with that new loan limit, you can basically buy an $807,000 house with 5% down, which is right around $41,000.
Okay.
For a down payment.
Right. Okay. Well, this is some good information. Thank you, Jeff.
No, my pleasure.
Yeah, thank you for being on the show. And I hope you guys got a little tidbit of information. I know we're throwing around a whole lot of numbers and, loans and things, but maybe it gave you some ideas or things that could spur some thoughts. And again, thank you for being on the show. You guys make sure to subscribe and scroll all the way down to the show and leave me a review and let me know if you have any other topics that you want to hear about. Thank you so much for listening.